Live. Good morning to everybody and welcome to Beyond the Markets. Thank you very much for joining us. This is the Wealth Wednesday edition where we shall be going through the bond auction from last week. We'll be going through a bit of the news and data. We'll be talking about millionaire and billionaire statistics. Just a little bit of something to look for. I want to give you a number of the day. And also, I want to finish off on yesterday's topics of now that we found wealth, what are we going to do with it? Effectively, what it's just driving down to is what you should be looking at as the quality of life metrics beyond just the amount of money that you have in ones and zeros in your account, the amount of zeros you have in your wealth account, your investment account, whichever account you shall be counting. I don't know if we still have Vernon. Vernon, good morning to you, my brother. Vernon, can you hear me? Well, we will get Vernon back sometime later on during the day, but let's kick off and start looking at how we're looking on Wealth Wednesday. Thank you once again. Tell everyone, give us your name, where you're joining us from. Today's Behind the Markets, we are looking at, as I said, Wealth Wednesday, and we are starting off with the market roundup. We are seeing that the Kwacha has continued its 28 days of loss. This is the 27th consecutive day of the Kwacha losing value against the United States dollar. Zero down by the dollar up by 0.57%, uh, up 1.97% on the week, and up 9.66% in the last 30 days. And you can see it's up 7.59% year to date. You can see that it is in a bullish position into a strong buy, but it is heading into overbought territory. So it does seem that somewhere between 17.4 and 19.5 is where the dollar is supposed to be resting. You also are seeing that the Lusaka All Share Index yesterday moved up by 0.52%, mainly due to Standard Chartered shares going up, as well as Copperbelt Energy Corporation shares also going up. Standard Chartered shares up by 6%, Copperbelt Energy up by just by under a percent. But we did see that the All Share Index is back up at all-time highs, 1,189.09, up 11.6 on the year, 2.12 on the month. We do see that bonds are up 0.06% on the secondary market and down 0.7% in the US dollar index. And we did see that interest rates are still lingering somewhere between 24. Remember, they did dance down below 24. And they pushed back up to about 24.04. So we are still seeing interest rates still pushing upwards. We also are seeing that the rand yesterday did push up by 0.12%. Up from yesterday, down on the week of 0.43%, but up 1.54% on the year. So you can see the rand is still negative while the dollar is positive year to date. So you can see that that does actually still help us with our cross-border trade. But when it comes to on the month, we still have that little bit of inflationary pressure that can sneak in for the cross-border traders who have gone out there to go and buy things from South Africa and bring them back to Zambia for reselling. Those are the ones where we will find a little bit of inflation creeping into our economy. And also remember, South Africa is our number one import source. So 35% of our imports come from South Africa. So when you start seeing the exchange rate moving the way it is, that is inflation pressure on the rise. The other thing that we're paying attention to as well is our bond markets. As we said, year to date, bonds are up 11.22%, while we're seeing the in terms of in dollars, they're up 3.17%, mainly due to the loss of the currency of the kwacha so far. But we've seen that interest rates are up 0.4% so far year to date. This is still lower than those highs we had where we were heading towards 25% on the interest rates. Commodities also yesterday we did see a negative move in dollar in copper. Copper was down 0.2%. Oil closed the day just around 74. But something also interesting happened, Vernon. I think after hours, we did see oil even dip below 70. So it actually is showing that, unfortunately, due to high levels of supply and signals of high physical supply on the market, so we are seeing a constrained oil market where we might see a bit of a push down further, but it has kind of ricocheted back to about 73.06. So keep an eye out for Brent oil. It is actually pushing a little bit down yesterday, down 3.2%, and down 13.87%, while copper's down 3% on the year. Copper is going to be something we're going to take a look at in our chart of the day. Gold is up 0.65% as they're trying to get the vote on the debt ceiling in the US. We also did see that cryptocurrency up 0.53. It actually is trading nearly at quite a bit of a high there at a multi-week high, 53,000, 539,542 for one Bitcoin in Kwacha, up 79.52% on the year. Year to date, up 4.58% on the month, and up 3.91% on the week. Ethereum is up 70.55% year to date, up 1.21% yesterday, and up 4.71% on the week. While gold in dollars is up in Kwacha is up 1.23% from yesterday, up to 16.48% on the week. Remember, these wealth insurance assets, gold, Bitcoin, Ethereum, dollars, they are highly volatile assets. I always have to warn you. I think I've said this enough, Vernon, but what's going to happen is some person is going to come onto the show for the very first time, see that number and say, wow, I need to become a Bitcoin billionaire, and then bang, get whacked by it because they don't know the warning that you're not supposed to put the majority of your money in cryptocurrency. So for those of you who are joining us for the very first time, if you do that, you better be willing to take the volatility. If you're trying to get proper advice here, I'll tell you, do not go more than 15% of your portfolio in things such as gold, dollars, and cryptocurrency. You can spread them around. Commodities, dollars, and cryptocurrency are what you do to just kind of wash out that 15% of wealth insurance. 85% of your portfolio should be staying in conventional assets such as stocks, bonds, unit trusts, and property. That is where you want 85% of your wealth portfolio sitting. Okay, that is a minimum. You can push it higher if you're not comfortable with Bitcoin, USD, all that stuff. You don't even have to touch that stuff. Okay, you can keep 100% of your portfolio in the broader markets. Just keep buying and be patient, because at least those are the main things that they are more trustworthy assets. Unfortunately, when you see this kind of graph, people look up and say, wow, that's where we should be putting our money. And then, wow, they lose their money next week. So this is what we need to all warn you about. Right. So always look at differences. We are also looking at where we're closing out for the month in terms of our oil predictions for today. Remember, today we're getting an ERB announcement for oil fuel prices for the month. The expectation, it should be somewhere between 0.6, as the OMC did say, to 1 kwacha. So we're expecting a 1 kwacha push downwards in petrol prices. If we do see diesel prices come down, mainly it's because of the 10% reduction in global Brent prices that might lead to diesel prices also coming down. Remember that diesel prices are actually much a stronger indicator of transport inflation than petrol prices, because diesel is what is used for moving of products as well. So diesel actually has a stronger effect on the cost of goods, because whenever someone is moving maize from one province to a milling plant, they're using a truck which uses what, my friends? Diesel. Whenever things are being moved from one place to another between manufacturers, which is the cost of the goods you end up buying, what is the kind of truck that's being used? And it uses what? Diesel. So you can actually put it into your mind that diesel actually affects the cost of production much more than petrol. Petrol affects your budget, but diesel affects the cost of the goods you are going to buy. So if you're going to take a look at how inflation can be rallied down, diesel is the thing we're trying to pay attention to. You can get the diesel prices are already lower than where they were last year. If they push down another 2 kwacha, they'll be much lower. And that can even affect the cost of petrol, because it's what, Vernon? It's trucks that bring in petrol. And those trucks run on what? Diesel. So that should actually put it in our minds why we should be keeping an eye on the diesel price more than the petrol price. Seems counterintuitive, but it's actually logical. So the other thing we're also looking at yesterday is the four horsemen, where they closed out yesterday. Spanish inflation was down 3.2, was at 3.2%, 0.9% lower than where it was last month. Italian PPIs also came in lower by 2.2%. Into the negative, and Brazilian PPIs also came in negative 0.35%. This is signs that you're seeing global inflation starting to pressure downwards. So you can see that the supply chains are coming in weaker, so that the cost of things that we're going to be importing, we're going to be importing less inflation. South African money supply came in at 10.14%, up 1.24% higher than the previous month. However, private credit grew by 7.07%, down by 0.13% from the previous month. Remember, that's important because South Africa is also one of our major sources of credit in this country. So the more credit and money South Africa has, the more it probably spills over into countries like Zambia. US short-term interest rates also came in lower yesterday, while we also saw EU money supply down by 1.9%, which is not a good sign as we're trying to renegotiate our credit. We need them flushed with cash so that they can accept lower interest rates. EU private sector loans also came in 2.5%, lower by 0.4 where they came in. And Italian bond yields also came in higher. So there is higher interest rates, mainly due to the interest rate hikes that are happening by the central banks, such as the ECB. So global central banks are actually affecting the rates as well. Spanish retail rates, retail sales were at 5.5%. They dropped by 4.4% from the previous month. We also saw business and consumer surveys for the European Union also at 96.5. That's a 2.5 point drop, showing that business and consumer sentiment is also starting to come down, while Korean retail sales are continuing in contraction. In the industrial sector, we've seen that U.S. house prices are still on the rise continuously. That's good news for copper, though not good enough news. But unfortunately, industrial sales in Italy were at 4.3%. That's 2.9% lower. Chinese manufacturing PMIs are still in the negative, which means that Chinese manufacturing is going to be buying less copper, meaning copper prices are down. Remember that copper, the biggest buyer is China. So we have to take a look at also that, while also Japanese industrial production is also in contraction. So we're seeing more negative news than we're seeing positive news. On the inflation side, yes, inflation is under control. So that means the future of rate hikes might be slowing down, but we're still seeing contractions in the financial sector. We're still seeing slowdowns in global trade, while we're also seeing slowdowns in industrial production. So copper is going to have a little bit of a delayed effect. Remember, we're still in the margin for an oversupplied year of copper this year, an oversupplied year of copper next year, and then an undersupplied year in 2025, 2026. Going forward, copper will then go into a rally. So you have to take a long-term projection of what is happening. So that's why when you're looking at copper stocks, take a look very carefully and take a long-term position. Companies such as your CECs, your ZCCMs, these ones, you're taking a long-term position. Because, for example, let me give you a simple example, Vernon. Right now, copper is trading at 8,000. ZCCM gets 3% of Kansanshi's sales now because it no longer gets a dividend, it gets a royalty. So in these next 2 years, the revenue is going to be subdued, still much higher because now they're going to be getting about $50 million a year. But then going forward, remember that once the copper prices push beyond 10,000, 11,000, the expectation is that copper prices are going to be somewhere between $11,000 and $15,000. From 2025 onwards, because the shortage of copper that is around due to socialist policies in South America, ore qualities reducing in South America, and the increase in demand because of green electricity and also EVs. Those are going to punch into overdrive by 2025. So therefore, there's going to be a serious shortage. And also smelting capacity is going up in Indonesia, India, and China in between 2023 and 2027. Okay, so if you take a look at all those factors converging, copper price will be much higher. So these copper stocks that you start investing, be it CEC, be it CEC, and be it Copperbelt Energy, and be it ZCCM or any other copper-related stocks that rely on the export of copper, those ones are going to reflect much higher revenue, probably from 2025 onwards, due to the expected deficiencies in the copper price. Okay, so just keep that in mind. Also, LME warehouses are at the lowest they've been for a long time. So you don't buy those stocks expecting to cake in now. You buy those stocks expecting to see the companies performing better in the 5-year horizon. So you're buying the 5-year case, which is somewhere there, and then you start to expect probably that those companies will start to milk in a bit better. So your copper stocks, that copper thesis of stocks, will probably play out now. So this is the time to start piling into those ones, or not piling in specifically, but start buying into those ones specifically, especially the two biggest stocks on the stock market, ZCCM and CEC. CEC is 8 billion kwacha, ZCCM is 6 billion kwacha. These two are your two biggest stocks outside of ShopRite, which is not a listed company. It is just a dual listed company, but not a fully listed company in Zambia, because only 2.7 million shares are listed here. Now, let's get into our deep dive for the day, Vernon, as I go into the bond auction that took place. But welcome to everybody who is joining us, and thank you once again for being here with us. Now, let's take a look at the bond auction from May 2023. Now, summary notes says that the auction May 2023 BA of 390 million kwacha was raised, was the worst performance of a bond auction since December 2020. Yields did stay the same because the government's rejection rate of bids went up from 6.4% to 9.2%. So the government will not accept interest rates higher than what they're already paying. That's what's happening right now. So the upwards push. Now, in terms of treasury bills, those interest rates are up at 16%. They've gone up from where they were at 13 a while back to about 15, now to about 16. So treasury bills are sitting at about 16%, signaling that the pressure is upwards as it stands. But currently, we're waiting for our debt situation to be resolved. That conversation keeps dragging. The Minister of Finance shot off another statement yesterday saying that this has to conclude because it's hurting our country. Same swan song. We'll be waiting for any changes. We can't keep reporting the exact same urging and sentiments and promises. We're waiting for movement. I think at that point, right now, the whole market is waiting for movement. Added to this, what's also making this performance pretty poor is that NABSA remember, NABSA is one of your big investors, and banks are your big investors. NABSA and banks combined, and pension schemes, but NABSA, pension schemes, and banks combined are making up a huge chunk, by the way, of your pension. I mean, of your bonds. Remember that 69% of NABSA's portfolio is sitting in government securities. About 20-30 billion of it is sitting in government bonds. Okay. Then you've also got banks, which also have an equally high amount. So somewhere close, just under 50% of your government bonds are held between banks and NABSA, who are currently in the middle, Vernon, of making payouts to people. So they can't afford to take cash that's sitting in their banks to then put it into bonds while there are people who are seeking their money and they're trying to push that money out quickly. So currently, there's not enough firepower to get that money out. Until we've finished this whole payout cycle, and remember, I think we're less than halfway, the amount that is payable, because we're still somewhere in the 30s to 40% of people who can claim their funds, claiming the total amount. So really, that's where we're sitting at this point. So that is taking a lot of cash off the table for people to be able for bond auction participation. Once that cools down, you'll probably find NABSA and the banks a bit more comfortable now coming back into the bond auctions, because bonds are their cash cow. But really, they're relying on old stocks of bonds. We're going to be doing banking financial data going on. We're looking at the banking industry. Remember, we looked at the payments industry on Monday. We shall be looking at banking industry data by the end of this week. We're just summarizing it and putting it together for everybody. Now, so as you can see, the auction performance was the worst. Interest rates pretty much stayed the same across every single yield. You did see that all bonds performed around the same: 18, 22, 24, 25.5, 25.49 actually, 27.8 and 27.8. On aggregate, we've seen that bond interest rates are about 25.1%. Now remember, on the secondary market, it's 24.4%, meaning it's kind of cheaper to take your bonds from the primary market and sell them on the secondary market, but we're still not seeing banks playing that game of buying on the primary, selling on the secondary, because currently they're still trying to deal with liquidity issues to make sure they have sufficient liquidity to pump into NABSA payments. Remember that 1 in every 3 kwacha deposited in a bank is actually NABSA money. So if NABSA needs that money, the banks cannot afford to start playing that. And usually NABSA deposits are long-term money that the banks play bonds with. So you've got to understand that's what's limiting them at the moment. But if we're also taking a look at some of the data here, we did see that sales were down in the bond market. Sorry, I think this has just covered it for a minute, but sales were down. You did see that each of them, in terms of month-on-month, 2-year sales were down 63%. 3-year were the only ones that were up 37%. 5-year was down 69%. 7-year was down 75%, 10-year was down 32%, and the 15-year was down 29%. So that shows you how badly the sales targets were moving. Now, if you're looking at performance, none of them performed over 50%. Nothing across the board raised more than 50%. I think this is the worst 2-year performance I've seen before. I've never seen a 2-year performance this poor. Only 5% of the money that was eligible to be raised on the 2-year market was raised in this last auction. That shows you that people are quite antsy about taking even 2-year positions. 3-year, and also because I think the 2-year is still underperforming in terms of the return on investment. The 3-year is the one that you can see at least went up by 8%, it's 28%, and the 10-year was 25% due to rollovers. But everything else, interestingly, even the 15-year was higher. This is the first time you're seeing much more coming from the long end than from the short end. That shows you how poor performance is happening in short-term bond acquisitions. especially that the institutional buyers are pretty much standing on the sidelines now, be it the banks and the pension funds. They're all pretty much standing on the sideline, especially NAPSA. We also are seeing that monthly compositions of all of this was pretty much made up of 32% of the 10-year bond, 29% of the 3-year bond, and 18% of the 15-year bond. The other minor amounts were the 7, 5, and 2-year bond. 2-year was the worst composition. We are used to even the 2-year being 30 to 40% of the money raised. This time, 2-year was just 3%. This is how bad it's gotten. If you're looking at sales targets, meeting sales targets, in terms of the short end, we only saw 13% of the sales target raised and 17% of the long end sales target raised, while you're seeing 46% of the composition coming from the short end and 54% of the composition coming from the long end. So for the first time, we're seeing long-term bonds doing better, and it takes this kind of disaster. In the year to date, where things are looking year to date, you're seeing 2-year bonds are down. 2-year bonds are down 42% from where we were at this point last year. 3-year bonds are down 53%. 5-year bonds are down 75%. 7-year bonds are down 91%. You are seeing bad performance across all spectrums except the 10-year and the 15-year. 15-year is the one that's actually performed quite well. 513 million raised, 62% up from where it was last year. It's had a little bit of a bounce back. Year-to-date performance targets, 81% still on the 2-year, mainly because of the early parts of the year where there was high performance. And that is now getting shredded off. 3 years only performed 54% year to date, while the 10 years performed 58%, and the rest are still way below the 50% mark. Only 39% performance in terms of the year to date, and the composition for this year's money raised so far we've seen is 29% of the money is in 10-year bonds, 24 in 2-year bonds, and 21 in 3-year bonds. So far, it's still leaning towards the shorter end in terms of shorter term bonds, but it is starting to creep up in terms of long-term bonds. You can see up 11% from where we were year to date last year. This is bond data for what we're seeing. Now, if we're taking a look at, as I said, where things were standing versus last month, I think the worst drop there is the 5-year bond, which went from 169 million kwacha raised to 52 million kwacha raised. That's how poorly the performance is. The only one that rose was the 3-year bond, which went up by 100, which went up from 114 from 83. Everything else underperformed from the previous month. If you're looking at in terms of performance, in terms of percentage performance, same story. Everything basically knocked out and underperformed. So this is the thing is the government is having trouble raising money on the bond markets right now because of not enough. Unfortunately, this is the negative side effect of the NAPSA withdrawal policy, in that liquidity is required now on the market. And the liquidity profile has changed of the pension fund, and also the liquidity profile has changed of banks, not allowing them then to push in capital. This is opportune, by the way, for the retail investor. This is when you pile in. When bonds are underperforming, there's no threat of interest rates coming down, but the government is also rejecting. Now, this is something we are tracking. These are the rejection rates versus the previous month. Sorry, the light bar is April. This is the percentage of bond bids that were rejected by kwacha value. Okay, the percentage of bond bids that were rejected by kwacha value. How much of the value that was bid was rejected? As you can see, we've gone from 6.4% to 9.2%, from 2.9% of 2-year bonds being rejected to 7.7%. And the rejection is mainly because the interest rates that were being bid for were too high. As you've seen, that the rejection rate for the 3-year bond has dropped, but the rejection rate for the 5-year is up from 2.8% to 7.8%. For the 10-year is up from 4.7 to 8.9. And the worst one is the 15-year. People were coming in with interest rates that were way too high, 11.8% to 19.6%. So this already tells you that the government will not tolerate high interest rates. They would rather just not spend money. We're not used to hearing that. But if they cannot raise the money at a decent interest rate and they don't have it in taxes, they would just rather not spend any money. And they are trying to keep their domestic borrowing to 3%. So this is what's going to keep the banks in check, that the government, in as much as there's underperformance, the government is rejecting anything at a certain level. So they're coming in with a standard interest rate. Other thing that we're also seeing on the market is the bond auction compositions also across the various tenors. As you can see, we pointed this out. bond auction composition went up in terms of the 3-year. That was the main one that really pushed up from 13% of this bond auction from to 29%. And as we pointed out, if you take a look at the end there on the right, that is where look at how high the performance was from June 2022 when we're having 62%, 57, 100%. We're getting very strong performances and even much stronger the years before, the months before. But if you take a look at from February onwards, these have been the worst bond performances you can see. 25%, 29%, 24%, 15%. The percentage of money the government was looking to raise, these are the worst. And these are the good times to invest. Because remember, you have to be counterintuitive. When nobody's going in, that's when you go in. When everybody's coming up, that's when you stand back. Because that's when you may not be able to get the best out of it. And once you see these bonds starting to flood, it means interest rates will start coming down. It means corporates will be able to get interest at lower rates, which means stocks will start to mean the listed companies will acquire debt at much cheaper rates. Financing costs will drop, expansion activity will rise, stocks will rise. So that's what we're trying to balance between. As interest rates are still up, bonds are your game. Once they come down, stocks are your game. So it's kind of this seesaw. And that's why you're always supposed to keep bonds and stocks together, because one is winter, one is summer. You don't only have summer clothing in your closet, you've got summer and winter clothing so that you can easily transition. Right. The other thing that we also seen is interest rates are still somewhere around 25.2. Sorry about that block right there. But interest rates are still somewhere around 25.2, while the average 10-year is somewhere between 7.9 years. This is the historic auction composite 10-year in years. You can see that the more we have longer term bonds, the higher this gets, which means we're starting to lean towards the longer 10 years of the bond market. Now, just to give you some insight, this is what we see in terms of NAPSA. This is what I was trying to show you, that almost 1 in 3 deposits actually comes from NAPSA. So this was as of December 2022. This is where the deposits were coming from. 1 in 3 deposits was actually coming from NAPSA. This is what's constraining the banks from being able to put money in. These are savings deposits, fixed deposits that are sitting in the banks. And that is your rundown of the bond market. We'll be taking a short break just now, a quick ad break. We will be back in a couple of minutes as we talk about, Vernon, wealth, thinking beyond wealth. Okay, thinking beyond wealth.
All right. And
Okay, and welcome back to everybody. Thank you very much for bearing with us on that break. We are now back to talk about a little bit of life beyond wealth after we've come from our deep dive. I want to start by giving you our chart of the day. Our first chart of the day actually comes from the copper price, thanks to Bloomberg. We're actually able to see here that copper has wiped out all of its COVID gains. Now, it was trading much lower than 8,000 before the pandemic. Remember that we had that downswing, but copper got as high, and in fact, this is not even the full picture, but copper at one point got as high as 10,000. It got to record points in the early parts of 2022, but this year we have seen copper off those highs down to 8,000, even dipped as low as 7,000. So this is where we are right now. And we are just waiting now to see what the recovery is like. So copper is kind of getting back to that 7,000 point where it was just pre-pandemic levels, where it was between 5,000 and 6,000, heading towards 7,000. So let's as we said, if you're taking a position on stocks that have to do with copper, please push your projection out to 2025 going forward. Okay. Now, whether we'll be able to get the output out, one of the things you have to remember is a lot of these copper mining companies are also waiting for the times the prices get up so that they don't oversupply the market. The last time what happened was when China was building, they were buying up a lot of copper. A lot of copper mines went in, invested heavily, pushing a lot of money, everything. And then China pulls out of the market because they slow down their construction work. And as a result, they oversupplied the market and they ended up taking in a lot of losses. So they've kind of learned from that situation, and they're this time they're waiting. They're depending on the EV cycle, so they're waiting to put a lot of their stock at higher prices. So remember that this is where they're going. So they'd rather not even get the copper out the ground. That's why you're seeing lower production, and they're investing a lot in capital right now while they're waiting. So they can see that capital imports are still very strong. We're importing about $300 million worth of machinery coming in, and it's the copper industry that's doing a lot of that this year. So right now, production is prices are going to remain low, expected to tick upwards on the other side of 2025 and continuously stay elevated, at least from 2025 all the way to 2030, expected all the way to 2040, 50. You know, there's going to be a strong copper cycle. That's why they're saying copper is the new oil, because of the EV and renewables business, which is supposed to continue going all the way through, especially once we start getting to about 30 to 40 million electric vehicles produced a year. We are currently only at about 10 million electric cars produced. Sorry, 10% of cars produced are electric cars. We're getting past the 50% point somewhere between 2030 and 2040, with 50% of vehicles coming from EVs and electric cars using much more copper than even a regular car and many things. That is going to drive. Remember, the powertrain in an electric car is made of copper. So just that thing itself, that motor, that electric motor, that Tesla motor, is actually the thing that's actually made of copper as well as the wiring that's around it. So that is going to be a very important part of copper demand. And if you have millions of those things coming out a year, that's demanding tons and tons of copper that will then go into vehicles. So that's just something to keep. That's something to keep in mind. Expectation is that the world's going to need about 30 million tons. The demand is going to get very high in 2020, in 2025. So in 2050, that we're going to get to about 30 million, but we're only going to be producing about 15 to 20 million. So there's going to be a huge deficit. This is according to the Glencore CEO when he was at the Qatar Business Forum last year. So that's that's the foresight you have to start looking at this with. If you're looking for quick money and quick turns, tough. That's going to be a bad one for you. Now, quickly, Vernon, one of the things I wanted to put in people's minds. You know, whenever you see people having the wealth conversations, Vernon, people believe that being a billion, you know, we sit on social media obsessing about billionaires. And it's almost like millionaires, you know, people utilize the word poor when they talk to me, when they talk about millionaires. You know, the majority of this world are not millionaires, people. This is something to also remember, that millionaires only make up like 0.6%, 0.7% of the population. They're still not even the majority. 99% of the world are not millionaires. Okay, 99% of most societies are not millionaires. So let's put this into perspective so that we can all kind of figure this one out quite well. Even America, which is this is the land of the free, land of the prosperous, only 8% of their population are millionaires. 92% of the population are not millionaires. Okay, so that already tells you quite a lot. Now, if you're going to, and Dave Ramsey was having this conversation today because people were talking about Jeff Bezos spent $65 million on a boat. Well, that's because the guy is worth almost $200 billion. What Dave Ramsey was trying to say is that Jeff Bezos spending $65 million on a boat is similar to Jeff Bezos spending $65 million on a boat is similar to you spending $35 on shoes. Okay, it's a decent expense, but it's not much. That's the difference. It's actually not much compared to for the wealth that he has. Okay, or let me put this to you, Van. The average Zambian has $2,000 worth of wealth. Okay, I want you to put that in your mind. The average Zambian has about $2,000 to $3,000 worth of wealth. So Jeff Bezos spending $65 million. Okay, that is basically it's less than what 0.03% of his wealth. So Jeff Bezos spending the $65 million of his total of his wealth on buying a boat, okay, out of his 185, and I think it's $185,000 out of his $185 billion is the same as a Zambian spending 70 cents on something. Okay, and if we put that in kwacha, it's like an average Zambian spending 14 kwacha. Okay, so if you look at it relatively, you start to understand it's not a huge expenditure. Okay, you spend 14 kwacha getting on a bus. Okay, so that's what buying a boat is like to Jeff Bezos. Okay, it's the same as you getting on a bus. All right, so before you judge the man. Now, the other thing I wanted to also put out here is the percentage of people. Now, to become a billionaire, these people have done something phenomenal to society. They've often changed a system. In fact, Warren Buffett says it's often people who have become a system of life. Nike has become a system of athletic wear. It's become the tool that is used for athletic wear. They've become a way of life. Wearing Nikes has become a way of life. So you're either a system of life, a tool of production, or a way of life. You're a culture. So that's what makes you that's how you build $1 billion company. And it's something that can go internationally as well. So people like Jeff Bezos, these guys, they've created things that can cut across borders and they've become systems of life. Okay. So I think that's what you have to be careful of. Now, becoming a millionaire. So becoming a billionaire is a 1 in 3,043,971 chance. Okay. Not 1 in a million, Vernon. 1 in 3 million. Okay. 1 in 3 million. Right. Now, being a millionaire is a 1 in 43 chance. Okay. So you can see this is much more attainable and it's something that can be done with savings and discipline. There are many people, Vernon, who just decide to be frugal, save well, be disciplined, pump their income in, work a little bit harder, and they push that money and they build. Even here in Zambia, there are people with multi-million kwacha bond estates. Okay, bonds and property. That's the combination I see a lot. People who hold a lot of GRZ bonds and a lot of property together combined. They tend to hold some are stocks and bonds, but majority of people are bonds and property. Okay, Zambians are quite risk averse, and I've seen people with estates ranging from 1 to 2 million all the way up to about 10 million. Okay, these are the clients that we deal with, and I'm just telling you that this is the numbers that you can see. So if you and they do it through discipline. They've done it through, yes, some of them have accessed credit in order to build up things, and a lot of them also have built up their wealth in their workplace retirement. So there's also access to workplace retirement and workplace benefits. So it's this combination of workplace retirement benefits, bonds, and properties. So those are, I'll put it this way, in fact, for you: benefits, bonds, and buildings. These are the three things, because when it starts with the same letter, we can all remember it. Just put that in your mind, people. Someone write it in the comments. Benefits, bonds, and buildings. That's the easiest thing where you see the majority of Zambians have built their wealth, especially millionaire Zambians. They've built it in there. They don't even pay attention to what's sitting in their benefits until one day they look and they're like, whoa, I'm worth 1.2 or 3 or this. And then they've realized, oh, wow, I've actually got money sitting in there. I've got like 2 million sitting in there. I've got like 1.5 sitting in there. Then they've also put up some real estate. And then when we calculate the value of the real estate based on bond coupons, we also find that it's actually quite hefty. Quite a large sum of people are holding on to real estate. Though that's a market we all have to be quite wary of in terms of trying to get rich too quickly. A lot of these people have built their real estate portfolios over decades. Okay, they've done it over 10 to 20 years. A lot of these people have been building real estate portfolios for some time now. And it's the same thing even with bonds as well. And a lot of them have also become earners. So they've taken their earnings and they've pumped it into assets as well. So they're very aggressive on their savings. So they earn high and they save very high. Those are the other things I've also noticed with this group of people. So the discipline to become that millionaire is possible through the benefits, bonds, and building structure and very aggressive earnings and very aggressive savings that you've actually seen people doing. That's something I can point out to you. And people who generally take all their benefits and they throw them into the bond market. People who are also young entrepreneurs who take their profits and they throw them into the bond market. Those are also the people who are building phenomenal amounts of wealth as well. They're very frugal about taking their profits into that sector. But becoming a billionaire, people, is a different story. Okay? You can't do that with that method. You have to change a system of business. You have to change a way of thinking. You have to become something new. So that's why I wanted to kind of make this contrast for people to be able to see the difference in thinking. Now, does that mean, and now I'm wary of this conversation where people look down on the whole billionaire conversation. Okay? I'm very wary about this because the reality is that, millionaire conversation, because millionaires are very good for society. Look, the majority of us are not. This country only has about, 800 millionaires. It's a very short, small amount. Okay, out of a 10 million adult population, Vernon, it's that bad. Out of a 10 million population, we have 800 millionaires. Okay, that's how bad it is. It's only like 1 in 1,000, like 1 in 10,000 Zambians are millionaires. Okay, 1 in 10,000. That's how poor the number we're doing is because one, the employment rates are really low. Two, therefore, the payment rates are really poor, and even compounding to this, the savings rates are even worse. Okay, so we've got poor employment rates, we've got bad business rates, poor employment rates, and even worse savings rates. The people with money are still not saving. Okay, so these are the problems that we're trying to get around as a country. There's cultural issues along with structural economic issues that are not playing very well, but it is something we can work on. Through entrepreneurship and equity. If people focused a lot of attention, we'd build a bigger millionaire base. And trust me, once that wealth is there, the influence starts to come in and the freedom starts to come in. Now, I just wanted to answer one quick question before we round up today, Vernon, and this comes from so I just want to quickly acknowledge Blackchain Joe, who has said, please create a YouTube channel that we can hear. We could have where to find when you need advice. Please, you can catch me on my page as well. Please do that. We need your teachings. Will do, people. Will do. And then finally, we got a question here from Chilufia Malala, Chilufia Mulala, who has asked, are treasury bills also subject to withholding tax? Yes, they are. The interest earned on treasury bills, so on bonds, the discount is tax-free, but they tax the coupon. But on treasury bills, they tax the discount. 15% withholding tax and 1% handling fee by BOC, which is deducted from the treasury bill at maturity. That is actually the point. And we are hoping that as we're having budget discussions, retail investors in this country should be exempt from all withholding taxes on bonds and treasury bills. That is something that I personally, I'm trying to push to submit, and I hope that there will be support for that, because we want to encourage the individuals. Currently, we only have 3% of bonds and government securities being held by retail investors, while the central bank has explained that it does want to see more individuals holding government securities. Once to get that number as high as 10%, it's healthy to get that number as high as 30%. So we want to make sure that if we do that, one of the best tools we should use is to make coupons tax-free and also interest on all treasury bills and bonds tax-free for the retail investor. Vernon, that is where I knock out, and I will see you tomorrow. What's a gold investment? People will be talking about that tomorrow. I'll catch that question tomorrow. Vernon, I hand it over to you before I sign out.
Thank you so much.
Cheers, everyone. Have a good day.